This segment of the session will talk about the basic financial model that we will use to help each learner understand the concepts that are related to long-term planning and estimating the effects of what can happen in income statements based upon all of what has been covered up to this point. There is on the screen a display, a spreadsheet that shows a whole series of numbers, and what I will do is to walk you through the entire sheet so you understand each of the basic concepts and how it works, because there will be other iterations of this visual later on which will make key points, but it'll be important for you to understand how it's constructed in the first place. The basic flow for this particular spreadsheet is built around the operating statement for what I would call a typical small college. We have kept it simple on purpose, so all of the dollars are expressed as starting at 100 and moving from there. It makes the math easy to understand. It also helps each learner avoid the trap of trying to imagine whether this is their institution. The point here is to understand the dynamics of the math, because they will affect an institution of almost any size. We also have kept the descriptors of income and expense very simple to stay away from any detailed review of particular issues that people may have, especially around small amounts. So the revenue types are really in three categories. The first is from students, which is tuition and room and board. The second is investments, which is described as an endowment. And then the third revenue source is everything else. On the expense side, we also kept it simple. There are three categories. One is compensation, one is program, which is all the expenses that are not people related. The third one is debt and capital spending. Each of those in the base setup for the model totals 100, and so that's a convenience, but it will help understand the effect of changes in the math going forward. Across the top, you have a series of columns which are identified as base and then year 2, 3, 4, 5, 6, 7, 8. We put particular years in above that to give you a sense of time and place. But it is really important to understand that the flow in multiple years is an important part of the learning in this exercise. So we start with a base which has $100 of revenue and $100 of expense, and that leaves a net of 0. And then all of the other columns reflect what decisions or assumptions are made about what happens to the institution in multiple other years. At the very bottom of the page, there is a listing of three main statistics. One is what we call net, which is the amount of money left over at the end of the year. Basically, it's the difference between expenses and revenue. And it starts at 0, as mentioned before, and then it will change based upon the assumptions. The second one is the discount rate, which is the amount of financial aid that is given to students, so therefore not collected by the college and therefore not available to pay any of the bills. That one starts at 47.8%, and it will change based upon the assumptions. The third line is net tuition per student. This is the amount of tuition that we earn from each student after their financial aid grant award is taken into account. And how fast that grows is an important input, so we did a calculation of that and show it at the bottom. In addition, there are two growth rates that appear underneath revenues and expenses to give you a sense for how rapidly each of those is growing. That is a crucial part of this exercise and a part of the understanding. And in order to highlight it, there's a third called difference between income and expense growth, and we have put that in a bold and reversed out white on red to show the differences between how fast your revenue is growing and how fast the expenses are growing. That also is a crucial part of the learning in this spreadsheet. Finally, there is a very significant column that is the second one in, which is called growth. And these are the assumptions that we have around how rapidly each of the elements is growing or changing. for this institution. Good example, tuition grows at 3.5% per year. That would imply, if the student body stays the same size, that the tuition is being raised at 3.5% per year. That is generally what we have been seeing on average across small colleges. There's some variation or some range, but we needed to choose a particular assumption, and so that's the one we've used. We also have created a growth rate that shows financial aid growing faster than that. That is also a feature that is pretty common. The growth rates for investments, room and board, gifts, and all the expense categories are really related to what we've been seeing in practice over the last several years. And they all can be modified, may have to be modified in some ways, but this gives you a sense for what would happen to this particular institution if the growth rates that are posited were the ones that were in place. When you look at the model, there's a simplifying assumption that says any growth rates that's identified is applied to every future year. So annual growth in compensation, for instance, of 4% means that from the first year to the second year it grows at 4%, but then the new number grows at 4% on top of that, so the differences compound. That's also an important part of the learning, because then the net effect of all these changes starts to show up along the bottom. So at the end of the review of this sheet, you have multiple years, you have income and expense, and you have some statistics that show what would happen if particular growth rates were applied or are achieved by a particular institution. That then brings you out to 2 or 3 or 4 years from now, but also 7 or 8 years from now.